The Money Show.
Personal Finance with Warren Ingram.
Well, it's been a little while, but I'm pleased to tell you that Warren Ingram is back. He's a certified financial planner at Galileo Capital. Warren, good evening. I'm not going to ask you where you were. I'm just glad to see that you're back with us. Tonight we're talking about why loyalty could be costing you money. And I mean, I immediately think of people who spend money on the same football team year after year. You're talking specifically around financial institutions.
Exactly right. I think it's one of those things where we find it so difficult to change banks or change insurers that once we're in, we tend to stay. And they even have a phrase for it. It's called inertia. And what you'll find is if you've been with the same bank or the same insurance company for a number of years, there's a very good chance that that you're probably overpaying for the services that you are getting now, and equally a fairly good chance that you could shop around, get the same level of services and products, but at a better price from a competitor of theirs.
Okay, so I mean, part of this, right, is just that some of the product providers, they do quite a lot to get you to come. I mean, they want to hook you, and there are all sorts of offers when you do that.
Yeah, I keep thinking, there are insurance companies that will pay you just to give you a quote. So they'll give you cash simply to ask them to quote on your insurance, even if you don't move. And I mean, that's a literal cost. They're actually paying you to try them out. And if you think about banks, I can't tell you how many times I've been suckered by loyalty programs where you get to fly around the world 17 times upside down if you swap banks and you do this or that, or the same with insurance companies where if you shop in a certain place and you exercise in a certain way, you get to do lots of interesting things. And all of those happen at the start of a cycle. So when the bank or the insurance company is deciding that they, whether it's to get more current accounts or to get more mortgages or whatever the deal is, more medical aids or whatever, then they make the deals very attractive. And so in a way, they either literally buy business or they cut their prices so low and make themselves so attractive that they draw sort of the bees to the flower. And once you're in, it's quite difficult to leave because of this inertia thing.
So, I mean, does that mean that once they've got you in, they actually know they're going to be able to charge you more down the line? They'll be able to increase their prices?
Yeah, I mean, if like me, your kind of personal admin isn't the best, and the prospect of having to shop around for a new bank account or a new insurance company seems incredibly daunting, the likelihood is that even if the product provider that you're with starts to make you grumpy because they increase the fees bit faster than inflation, they take away a few extra services which were really nice and probably attracted you in the first place, it takes you a long time to actually decide to shop around, number one, and then number two, to go through the pain of actually making a change. So what the institutions are relying on is they're going to attract a large number of people through the door. Nowadays, it's a figurative door, it's an electronic door, and then they know that because of inertia, you're going to stick around. And even if they lose a few clients, 5 or 10% of the people they've attracted, they've got a large number of them on their books now, and gradually over time they start to reduce the services they offer you. They make the loyalty program slightly less attractive, and the fees go up a little bit, and that incremental friction every single year it's irritating, but they don't make such a radical change that you shift in a year. That you find that it happens over 3, 4, 5 years where eventually you might be prodded to make a change.
So, I mean, loyalty programs, are they a good indicator of something? If, the promises are too good or they start to get lower and lower, your benefits don't really make sense anymore.
Yeah, this for me is the thing. So when you see these programs, especially in the early days, they are incredibly attractive, and so it makes sense to shift, and so you do, and you move from bank A to bank B, or you change medical aid or short-term insurance provider. And once you're in, I think my first point to anybody is be very careful and very clear as to what it is that you've been offered, why have you made the change, and then track that from 1 year to the next. And when you start to see that loyalty program, which is award winning and attracting lots of interest, when it starts to slip, and you start to realize that actually, potentially the loyalty program is now rewarding behavior that, maybe you don't want to do. For example, for me, I'm not going to borrow a lot of money. So if my bank's loyalty program is now incentivizing me to get more credit cards and get more debt, well, that's not good for me. I don't want to do that. And so I'm going to monitor that loyalty program very carefully. And when I see the benefits reducing, it becomes a great signal for me to shop around, because I think I can probably get a better deal from a different bank. And sometimes it's not always the new banks. Sometimes it's the old banks that want to refresh their client base. But I am going to shop around and look at and see what I can get elsewhere.
We're speaking to Warren Ingram, the co-founder of Galileo Capital. Your questions for him tonight on 011 883 0702 and 021 446 0567. Voice notes too on 072 702 1702. The cost of staying loyal, tonight's subject. Banking products. Let's just focus there for a minute, Warren. I mean, I'm guilty of this too. You have lots of different fees for different types of accounts, and actually with a little bit of research, you can see what the differences are and what you really need.
Yeah, and it's so interesting. Now we're going to have to go back a little while ago, but if you think about when Capitec arrived on the market, we had the established banks and they were delivering a set of services, and all of a sudden this challenger bank arrives and offers very low fees, and then people that were in mid income or high income products would be going, well, the service is going to be terrible, so I'm not shifting. I don't care how low the price is; it's going to be awful. And what happened actually was the opposite. That the challenger bank delivered good service, and so that's happened again and again. We've seen more and more banks coming onto market and challenging the established operators. And now, funny enough, Capitec is not a challenger; it's an established, very large, competitor. And there are other people out there, other banks doing the job now. And so for me, the core message here is, when you see what's on offer, do you need something more complex than a very basic savings account, credit card and the like? Very often you get charged for a private banker, and a lot of the time when you phone the private banker, they're never available, and you get directed to a call center. So you don't have a private banker. What you've got is a call center, and you're being charged potentially 500, 600, 700 rand a month for somebody that's actually not there to help you. They're going to direct you to a call center. And in my experience of this is to say, be very clear that you're paying then for something that's maybe a little bit of ego, and that's fine. Or are you paying because you want to get a better lounge when you're flying, or what's the deal? But is it worth the money you're paying? Potentially you get a very low cost account that delivers all the services that you need, and then you pay for the extra things. You pay for the lounge, or you pay for whatever it is that you think is amazing from the loyalty program that you used to get.
Your home loan, is it worth reviewing that? I mean, I think a lot of us just think, well, the home loan's there, I'll deal with it in 20 years, hopefully.
Yeah, and if you've been, our listeners of the Money Show would say, we're not paying it off over 20 years, we're going to pay it off over 8 or 12 or something. Yes. And so, but you're right. You make this deal with the bank, and you think, well, it's cast in stone. Now I'm going to honor the contract for as long as I've got a mortgage. And I think to understand the dynamics of how banks work, they are incredibly competitive businesses. So you'll find that Bank A will have a nice mortgage book, and you might be a client of Bank A, but Bank B decides that actually they don't have enough mortgages, and they want to grow their mortgage book. So very often they'll go along and they'll say, we're offering prime minus 1.5 or something, to the right sort of profile customer. Usually they don't want high risk, credit risk customers. And so if you've got a history of paying off your debts, it's really worth your while to shop around on your mortgage. Let's say not every year. I think that would be excessive, but every 3 to 5 years, and see what interest rate you could get from another bank. And then I think the one thing I want to say here is, it's not just the interest rate that you've got to be careful of. It'll be the fees that you're currently paying, because there will be fees as well. And then most importantly, you need to know that if you're going to swap mortgages, you're going to go from bank A to bank B, that means that a new mortgage has to be registered on the property. And that means new fees, new costs, new lawyers that have to be paid. So don't just swap from bank A to bank B because someone saved you 0.1% interest, and then you actually realize that the fees have destroyed the benefit. But shopping around very often can help you, and you get a substantial saving on interest rates from banks that are really looking for new customers to offer mortgages to. So definitely, it's one of those things where it's not just a 20 deal that you can't shop around. You can shop around, and it'll pay you to do it.
Yeah, it's so interesting. Andre has got in touch with a question. Andre is asking, with all the wars happening around the world, should I still keep investing my money? I'm wondering if it would be better to de-risk my investments for a while until the world is more settled. Just one of the questions coming through.
The Money Show.
Personal Finance with Warren Ingram.
Well, Warren, we'll get to Andre's question in a moment. First, Norman, you're on the line from Joburg. You've got a question on funeral policies for Warren. How's it, Norman? Go for it.
Yes. I've taken out a policy about 10 years ago, and what they've calculated, I would be able to get 20,000 rand if I die. But at this stage, I think I've paid about 70,000 rand already.
Wow.
Will you be able to review that, or must I just continue until I die?
Sure, Norman, yeah, that's a lot of money that's gone in there. Warren, your thoughts on that? I mean, it seems that Norman's being overcharged somewhere, if the numbers are right.
Yeah, it's unfortunately quite common, Stephen, with the situation Norman's in. So you've got to price these things regularly, and I think Norman's question is so valid to the conversation we're having, because I would guess if you shopped around for a funeral policy every couple of years, you would find that you'd probably able to get a much better price. It also points out, know what you're buying, because if you're buying a policy that's going to cover a funeral for 20,000 rand, the first thing I'd be doing is to say, can I build up an emergency fund, for example, that the family have access to cover a funeral cost, and start saving as quickly as I possibly can, because if you can, then can you get to that 20,000 rand and then stop the funeral policy? So I think there's two things there, Stephen. One is, shopping around would have helped Norman a lot, and in my view, definitely you want to shop around right now to check and see if you can't get either much more insurance. In other words, you get 50 or 80,000 rand for the same premium, or if you're happy with 20,000 and that's all that's needed, then can you get it at a much lower price? And I think shopping around would help a lot. And then number two, please do your homework as to what you're paying for and the benefit that you're getting, and see if you can't get to the point where you can cover those costs from your own savings.
Yeah, that's so interesting. All right, Norman, I mean, does that help at all?
I hope so. I'm going to try the method that you say I must try now.
All right, Norman, thank you. All right, interesting question on the line from Joburg. And then, Warren, Andre's question was around, with all of the wars happening around the world, should I still invest my money? I'm wondering if it's better to de-risk my investments for a while.
Yeah, I think that question from Andre is lots of people are asking variations of this at the moment, and it I think if we had sat in a conversation like this mid-morning on Monday when it felt like the oil price was just on a tear up to $200 or $300 in it felt like, and markets were imploding in Asia. It did seem, in some ways that maybe we were in for some very tough times, and maybe to talk through the journey of what happens there, because we start Monday and it looks really bad, and there is a massive humanitarian crisis going on. So we mustn't divorce ourselves from that. But when we're looking at our investments and markets in general, we need to anticipate what will happen slightly longer term. So when the news flow is really bad and it seems very scary, as an investor, your job is to stop, take a breath, and try and just zoom out a little bit to say, most of the time markets react, with a little bit of panic, and once they calm down and they start to think and to breathe properly and to read and analyze, they start to recover from that panic. And I think that's what we've seen in the days since Mondays. We've just seen the oil price recovering. Yes, news flow has had an impact, and so markets have recovered very strongly since then. And so I would say to people that in this kind of situation, you shouldn't de-risk your portfolio based on a shock. The oil price jumping up because of a war. If the war sustained and infrastructure is destroyed, that could cause the oil price to stay high for a very long period of time. But if the infrastructure is not really badly damaged and the war could stop very quickly, then you've got to be very careful of de-risking your investments. So I think you de-risk your investments because you're in a situation like this, and potentially you were over-invested in very risky investments to start. So in other words, if you should have had 50% of your investments in shares and you had 95, this is a wake-up call. Reduce your allocation to shares. But if you were correctly positioned, then you need to ride this out. This is one of the storms we knew we couldn't predict, but we knew a storm would come, and it arrived. You've got to ride it out.
Yeah, no, I think a lot of people are having that thought. All right, short-term insurance and the cost of loyalty there. It's quite high with short-term insurance, isn't it, Warren?
It is, and I think the friction of changing is much better here. So with a home loan, you're going to pay lots of legal fees, etc., to switch. But with short-term insurance, it's not that difficult. You're typically on a month-to-month contract. So if you set yourself a goal of reviewing your short-term insurance once a year or once every 2 years, and you then decide to switch from one insurer to another, you're not necessarily. I don't think you'll be in for any kind of penalties. So you can find that shopping around with short-term insurance can save you a lot of money without having to sacrifice any change in the product that you're actually buying. And so sometimes when insurance companies say to you, look, I'm terribly sorry, your premium's gone up by 14% because of repair costs of cars or inflation or whatever it is, that might be true. But equally, there might be another company that's very happy to give you the same cover at a better price. And you absolutely need to shop around to make sure you're getting the right deal there.
And I mean, if you haven't had a claim for quite a few years, I mean, obviously that makes you quite attractive to an insurance company. Is that useful?
It is, and it's so interesting that short-term insurance companies very often even have a thing called the retentions department. So when you tell your insurance company, look, I've been a client for a long time, I haven't claimed, and I want you to review my policy or I'm going to move, they often transfer you to the retentions department where they will, renegotiate, and drop your premium. So it's certainly worth asking the existing insurer because, they've done all the hard work of getting you on board. Yes, they might be relying on inertia, but if you push back hard enough, they might give you a better deal. Equally, you need to be prepared to make the move then and go somewhere else if you're not going to get a better deal and you can get one elsewhere.
You need to watch the T's and C's too?
Yes, the one thing here that really worries me is, let's say you've got comprehensive insurance on your car and it's costing you 3,000 Rand a month, and then another insurance company says, don't worry, I'll give you insurance on your car and it'll only cost you 500 Rand a month. That's such a massive difference. You need to make sure that you're comparing apples with apples. Are you replacing comprehensive insurance, for example, with only third party where they're not going to look after your car at all? They'll only look after the car that you drove into if it was your accident. So I think you've got to make sure that you are checking these and making sure that if you're swapping, you're getting the same level of cover and all the things that you were offered from the first company, you are being offered by the second company. And if it's a better premium, then by all means move. But if it's half the price, you need to be very careful. Yeah. There might be something that you're not being covered with.
Warren, we've got literally a minute and a half left, but Lebel's phoned from Krugersdorp, and Lebel, quickly, if you can, please. Your questions about bonds, property bonds.
Yeah, I wanted to check if you have a bond with a bank and then you want to apply for a further bond and the other bank gives you a better interest and a better value. How does it impact you to take the other bond, the bond that is existing, and match it with the further bond that you needed?
Lebel,
I don't know if my question makes sense.
I think it does. Lebel, thank you. Warren?
Yeah, I mean, if you can, it sounds to me almost like you consolidate the two together, and if you're getting a better rate of interest at the second bank, then that's certainly going to help you on the cost of all of the debt. So it might help. Just be careful of all of the other costs that we spoke about earlier in the show.
Warren Ingram, thank you so much. Really good to have you back, the co-founder of Galileo Capital. I was glad you were able to answer Lebel's question, and of course Norman's as well.